reporting loans that you should not be reporting. That happens fairly frequently, and in fact, we're going to discuss a situation today in which a year ago or so we had a client bank that had over-reported a third of their mortgage applications that should not have been reported by them. And they got into quite a bit of a problem with their regulator because of that, and they had to go back and refile 3 years' worth of HMDA LAR data to correct what they have been reporting they should not have been reporting. The second type of error that occurs is when you do not report loans that you should be reporting, just the opposite of the first type of error. And we want to make certain when you file your HMDA LAR that you're filing only those loans that you should be filing for and that you're not omitting any mortgages that you should be reporting. Now, once we get to the point where you're actually filing the loans that you should be reporting, the errors occur most commonly in the action type field, the action date field, the loan purpose, loan amount, income, and race ethnicity fields. According to my discussions with the regulators, those are the fields that have the most frequent occurrence of errors in the HMDA LARs. So we're going to really focus on those fields today and talk about the kind of errors that are made and what the underlying cause is for those errors. Now, in general, when we're talking about reporting errors, and we're talking about either reporting or not reporting what you should be reporting, you can discern there's four major situations that seem to be linked to when people are reporting incorrectly or not reporting properly. First of all, there's what's called the broker-investor situation. And that was something I myself wasn't too much aware of until only about a year and a half ago when it came to my attention through a client that developed a serious problem resulting from this. And it's a very esoteric part of the Home Mortgage Disclosure Act that most people aren't even aware of. And when you are aware of it, it can be very confusing. And I want to make certain that each and every bank today that's participating in the webinar is aware of what the broker-investor situations are and how they might very well affect your bank. So we're going to talk about that. Temporary financing is another situation where banks get confused a lot and end up reporting loans they shouldn't be reporting, and we're going to discuss that. Another thing that we find that banks do that causes reporting errors in terms of reporting loans they shouldn't be reporting is they will report under the Home Mortgage Disclosure Act non-dwelling secured loans. They actually think that almost every mortgage that is recorded is reportable, and they end up reporting loans that they should not be reporting. We will talk about examples of that shortly. And finally, banks, believe it or not, frequently report dwelling secured loans that do not have or meet the requisite purpose under HMDA, the Home Mortgage Disclosure Act. So not only must you be reporting a dwelling secured loan, but it has to be a loan that was done for a purpose that is enumerated under the Home Mortgage Disclosure Act. Those four underlying causes or factors contribute to a lot of reporting problems with banks, and we're going to talk about those in some detail. Let's talk about, first of all, this investor-broker situation. Now, some of you might be sitting there thinking, this doesn't pertain to me, we don't deal with that. But you might be surprised in how this is interpreted and how it very well may apply to you. So let's talk about the investor-broker situation to begin with. There's a high potential for mistakes here, for very critical mistakes, because you have to determine who reports what. And in an investor-broker situation, what you thought was a clear rule of thumb may not apply, and we're going to just talk about that. There's a high potential for misunderstanding because of confusion about the terminology, and it lulls bankers into the belief that they don't fall into either the investor or broker category. Basically, you've sold the loan to a purchaser, and that's the common feeling. Oh, we originated it, we sold it, we're the originator, and the buyer is the purchaser. There's also a very high potential for a very serious error here because when banks do act in an investor-broker situation, it normally reflects a significant percentage of the loans because it reflects the way a business a bank is conducting. Banks don't usually just do 1 or 2 loans a year that fall into this category. If a bank is involved in an investor-broker situation, it can become a significant part of their HMDA activity, and therefore it's not, when an error occurs, it affects a very large number of applications and can really put the bank in a difficult situation when they do improperly report these loans or improperly not report the loans. So we need to discuss this in a little more detail. Let's talk about what a broker is and what an investor is, okay? And a broker is an institution that takes and processes a loan application and arranges for another lender to acquire the loan at or after the closing. That sounds pretty straightforward. An investor is an institution that acquires a loan from a broker at or after the closing. So far it sounds pretty clear. I'm certain most of you are saying, yeah, that's pretty straightforward. How can anybody get confused about that? Now, let's talk about how it gets confusing. As a general rule, almost all of you, probably all of you actually, have heard that whoever makes the credit decision is determinative of who actually reports. And in the ivory soap percentage of time, 99.44% of the time, that's probably true. But there is the one exception, and that is in the investor-broker situation. And in the investor-broker situation, the bank may make a credit decision, but still may not report a mortgage under HMDA because of this, and I'm going to explain that. Let's take a look. If a broker makes a credit decision on an application, it reports that credit decision. If a broker does not make a credit decision, it does not report that transaction. Now, if a broker makes the decision on the investor's underwriting criteria, but without the investor's review prior to the closing, the broker has made the credit decision. So far, again, that's pretty straightforward. This is where we start running into the problem. If an investor reviews an application and makes a credit decision prior to the closing, guess who reports? The investor reports, not the broker. And that is even if the broker has made a credit decision, advised the client of the credit decision, and has committed to close the loan, they made the credit decision, and therefore most of you would think, oh, the broker has to report this, but that's not true. In this case, the investor would. If the investor does not review the application prior to closing, it reports the loan, only the loans it purchases as a purchaser. So, if the investor is obligated to report, why would it be obligated to report? Because it reviewed the loan and made a credit decision prior to the loan closing, and then it subsequently purchased the loan. Then the broker does not report the origination as a loan at all, not as a loan originated, purchased, or sold, or anything. Even if the broker himself or herself or the bank itself made the credit decision. This is the exception to the, quote, credit decision maker is the reporter rule. And I want to say this again. I've seen in the last 2 years, I've seen 3 or 4 banks get into very, very significant difficulty because of misunderstanding the situation, and there were civil and monetary fines of significance imposed, in addition to the fact that they had to go back and refile their HMDA LARs. Now, to make certain that you understand this, let's go through a couple of scenarios.